If rising healthcare costs are squeezing your bottom line and leaving you with little control, you're not alone. I'm Rich Westermeyer, founder of Benesmart, and today we're unpacking exactly what a captive is and why group medical captives could be a game changer for mid-sized employers. In this video, I'll guide you through how group medical captives are helping businesses take back control, providing both stability and long-term savings. Have you ever wondered how large corporations manage to reduce their insurance costs while still offering robust benefits to employees? The secret often lies in captives. Before we dive into group medical captives, let's define what a captive is. A captive is an insurance company set up and owned by a business or a group of businesses. Instead of buying traditional insurance, the business uses its own captive to finance its risks. This model allows for greater control over underwriting, claims, and ultimately your cost management. Many of you may be familiar with this concept if you've ever explored or participated in a P&C or workers' compensation captive. These tend to be a little more popular. Some key points about captives. 1, it's a self-insurance mechanism. 2, it's owned by the insured, providing more tailored risk management. And then 3, it offers the potential for cost savings and greater control over claims. So what's the difference between that and a group medical captive? Well, let's narrow it down. A group medical captive is a specialized captive focused on managing healthcare expenses. Employers join forces to create a pool that self-insures medical claims. This approach can lead to lower premiums, increased predictability in the costs, and a tailored solution that meets the unique needs of your organization. Picture this. Imagine 5 mid-sized companies pooling their resources to create their own insurance company, one that gives them the power to manage healthcare costs and claims directly. These employers benefit from the law of large numbers. This law holds that in the group health plan context, the larger the number of lives independently exposed to loss, the greater the probability that the actual loss experience will equal the expected loss experience. In other words, better data increases with the size of the data pool, thereby leading to greater predictability. This is huge if you're trying to manage this expense. Lack of predictability can be a significant roadblock to self-funding for a mid-sized employer. A captive can help alleviate this barrier. In the next few sections of our video, we'll answer 3 questions. How does a group medical captive work? Who's eligible to join? And what are the basic requirements? As we discussed earlier, employers join forces to create a pool that self-insures medical claims. There's that word again, self-insure. But wait, before you close your computer, I think you'll want to understand how a captive could make self-insuring a very real possibility for your group, where it might not have been on your radar before. In a captive structure, your risk is spread across multiple layers to ensure robust protection from losses and to maximize cost effectiveness. Let's unpack these layers with an emphasis on the health plan supply chain. Here on one hand, we have a traditionally funded, fully insured health plan, which has 4 main components: your third-party administrator, a network, pharmacy benefit manager, and a risk pool. This risk pool is made up of similar employers. This is your risk transfer mechanism. Then, in a level funded plan, the risk transfer mechanism changes to stop loss insurance just like it does in a self-funded plan. So how does a captive differ? Well, the biggest difference lies in how the plan transfers risk, and an equally important difference is in who manages the plan, or in this case, I should say, who's not managing your plan anymore once you move to a captive. Let's dive into how a captive can help you shift and transfer risk. Let's look at how a captive can help you shift and transfer risk. Just like you might have now, in a captive plan, you have a claims fund. This is the primary fund where employers pay for everyday predictable claims. Routine medical expenses are handled directly from this reserve, keeping common costs in-house. Next, in a captive, you have the captive layer, or what we call your shared risk layer. So beyond the claims fund, employers contribute additional capital to a pooled captive fund. This shared risk layer is designed to absorb claims that exceed the capacity of your claims fund, but remain within expected or moderate levels. By pooling these funds across multiple employers, the captive layer enhances risk sharing and leverages combined buying power. So think about that for a second. You have your first layer of risk, which is your everyday claims. Then your next layer for more moderate claims is the captive layer. And this kind of collective approach reduces the frequency and severity of claims that need to be escalated further to stop loss. In your captive arrangement, you do still have stop loss insurance, which we call your transferred risk layer. This is for catastrophic claims that exceed both your claims fund and the captive layer. This is where stop loss insurance is employed. Since these everyday and moderate claims will be managed by your fund and the captive layer, the stop loss insurance only covers infrequent, high severity events. This focused coverage, combined with enhanced negotiation power from pooled resources, often results in significantly lower stop loss premium. Let's take a look at how this makes your stop loss cost less. Number one, you're no longer transferring all of the risk above your claims fund to your stop loss. You're only transferring a portion or a tranche of that risk to your stop loss. So you have some of your risk living over here in your claims fund, then another portion of your risk living in the captive layer, and then finally you have the third portion of your risk which you transfer to stop loss. The less risk you transfer to stop loss, the lower the cost it is to insure that risk. Additionally, we hit on the fact that you have a greater buying power because instead of buying a stop loss insurance policy on your own, you have the pooled resources of the captive to help in leveraging for greater cost control in your stop loss. So who is eligible to join a captive? Our captive partners welcome a diverse range of employers upon evaluating some of the following criteria, starting with employer size. Typically, employers in a group medical captive will have at a minimum 50 employees on their health plan. Next up, they're going to look at prior funding strategies. We've seen employers enter captives after years in the fully insured market. However, most employers who join a captive have a better start if they're already level funded or self-funded with an active history of managing their claims spend. Speaking of claims, most captives will want to evaluate 2 to 3 years of claims data. This can be challenging to produce if you're fully insured. So what are the basic requirements? Well, you have financial commitment and stability. Potential members need to commit to contributing capital, not just to their own claims fund, but to the captive layer. Stability in financial operations is crucial as it underpins the long-term success of the captive. Next, you have regulatory and operational readiness that you have to consider. You must be ready to navigate the regulatory landscape and adopt the disciplined management practices required for a captive. This includes engaging with experts in areas like actuarial science, finance, and compliance. Before jumping into a captive, there are essential questions you need to ask. Here are 5 questions that should be on the top of your list. What are the qualifications and experience of the captive manager? How is the risk shared among the members? What's the financial stability and performance history of the captive? How will claims be managed and what support will be provided? Are there any hidden fees or additional costs? Another one I'd throw in there is, who are your cost containment partners? If you're a mid-sized business struggling with unpredictable healthcare costs, this could be your path to stability. Group medical captives can offer a strategic advantage in managing healthcare costs for the right group. If unpredictable premiums and limited transparency have held you back, now's the time to explore new options. Reach out to learn more about how captive could fit your organization's needs. As your partner in healthcare risk management, we're here to guide you every step of the way. To learn more about captives and our preferred partners, head over to our website and check out our captive buying guide under the resources section.